Why are you building a startup in accounting? Like, that's the most boring industry you could possibly think of.
Yes, I agree. The reason we got here is, I think like most founder stories, like very, very visceral personal pain. So this is the third startup for me and my co-founders. We were all at MIT together, undergrad. Right out of school, we started a company called HSpice. We all lived in this gross little row house in Cambridge, in Boston. And because we bootstrapped it, we had no money. We tried to DIY everything. I did our accounting. And so really the reason we started building this is because this is what we wish we could have hired in our first startup. As a founder or as a business owner, I don't want a piece of accounting software. What I want is like a trusted partner who's going to own this for me.
Do you know where you would rank in terms of sized accountant? I know they have the rankings on size. Where would you guys be on that list?
For startup-focused accounting firms in the US, we're the largest on, I think, literally every metric.
You talked about getting acquired by Oracle. How did that come about?
We've sold 2 companies, one to Oracle, one to Dropbox. My experience has been that companies are not sold, they're bought. There has to be something that piques the interest of the acquirer. Build something that's interesting and doing well that you don't want to sell.
The show Silicon Valley was based on your 2 startups, and you actually helped write the show. What was that like?
I chatted with them for a couple episodes, and there are definitely some anecdotes from HSpice that are very present in the story. I was very impressed at how well researched the show was. The team went to great efforts to really, really kind of nail the details, and I think you can see that when you watch it. Like, it feels authentic because it is.
Welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Turner Novak, founder of Nana Capital, a venture capital firm with the best accountant. Today, I'm happy to share my conversation with Waseem Daher, the co-founder and CEO of Pilot, the bookkeeping, CFO, and tax provider for startups and fast-growing businesses. Before Pilot, Waseem and his co-founders Jeff and Jessica sold their prior 2 companies to Oracle and Dropbox. We'll talk about all his mistakes building and selling those first 2 startups, why companies are bought, not sold, and why it's a mistake to build your startup just to be acquired. Waseem did not expect to spend multiple decades working in accounting. And we'll talk about when to do something internally and when to outsource, how to avoid fake work, Waseem's approach to getting ROI from conferences, why tech-enabled service businesses, which is what he's building, are so hard to scale, but why he's doing it anyways, his disastrous first ever meeting with the VC, all his non-intuitive but simple company building and fundraising advice for founders. Plus, stick around until the very end to hear about his experience advising the writers of HBO's hit show, Silicon Valley. Waseem is building his 3rd company, and I think you'll really enjoy this candid and straightforward conversation. Thanks, Waseem, for sitting down to chat. Now, let's jump in after a quick word from SecureFrame. Longtime listeners already know SecureFrame is the automated compliance platform built by security experts. Thousands of your favorite startups like Angels, Coda, and Ramp use SecureFrame to get, stay, and automate their compliance with security and privacy frameworks like SOC 2, ISO 27001, HIPAA, GDPR, and many more. If you ever tried getting compliant in any of these, you already know how hard and time-consuming it is. SecureFrame streamlines your compliance with AI, which saves you time to focus on growing your own business. I'm an investor in SecureFrame, and I recommend it to every founder I meet. Join hundreds of other listeners of The Peel and click the link in the show notes to get started on a demo with SecureFrame's in-house team of compliance experts and former auditors. Thank you, SecureFrame. And now, let's talk to Waseem at Pilot. Waseem, how's it going?
Good. Thanks for having me.
Yeah, thanks for coming. So, start things off, big question. What is Pilot?
Pilot does accounting, tax prep, and CFO services for startups. And importantly, what I mean by that is not we sell you a piece of software. It's no, we actually do your accounting. We employ a bunch of accountants that sit in our offices. And then under the hood, we've built for them basically the Iron Man suit, software that lets us do the work more accurately, more reliably, more consistently.
And so are you using other people's software, or have you kind of hacked around custom tools, built around the software, built your own? How does that work?
It's a little bit of all the above, actually. Like, our perspective, and I think this is in general good advice as folks are thinking about building their back offices. Our perspective is, look, when there's an industry standard thing, we should use it. So in other words, we do all of our work in QuickBooks Online as an example. Lots of our customers use like Stripe and Gusto and Rippling and Brex and Ramp and all that stuff. And where we're trying to focus our efforts in terms of where our engineers spend their time is, what is the work that is today done by the human accountant in a way that is either really slow and tedious, or more importantly, like really error prone? And that's the stuff where we feel like we have a proprietary advantage or a particularly interesting opinion about what to build, that's the place I want to be building software. I don't want to be building, yet another clone of product X if there's already a really great version of that in the market.
Why would I use Pilot over just any other accounting firm?
Yeah, great question. So one of the nice things about Pilot is the size and scale that we operate at. Like today, we have about 2,000 clients of various sizes and stages, predominantly technology startups ranging from 2 people in a garage all the way to, a 300-person team with a VP of finance and a controller and all that good stuff. And I think there's real benefit to working with someone who's seen the movie before, meaning we have the tiniest of the tiny and we have the largest of large until you bring it in-house. So we know what that journey is going to look like for you. So one is, I think, just the breadth of experience. 2 is just the scale actually means we can do more for you in-house than the average provider. Like we have an in-house CFO services team. There's a bunch of stuff we can do that's all kind of under one roof or on one menu in a way that, look, the local accountant is probably a smart, talented person, but it may also be just one smart, talented person. And if that person is sick or they're on PTO or they're just distracted or whatever, like they're not really going to be able to offer you that same breadth of support that we can.
Why are you building a startup in accounting? Like that's the most boring industry you could possibly think of.
Yes, I agree. And I think if you had traveled back in time and talked to past Waseem to be like, hey, do you want to spend several decades of your life working on accounting? I'd be like, no, unsubscribe. The reason we got here is actually, I think like most founder stories, very, very visceral personal pain. So this is the third startup for me and my co-founders. We were all at MIT together undergrad. We were all in the computer club at MIT. It's the whole thing was extremely nerdy. Right out of school, we started a company called HSpice. This was based on my co-founder's master's thesis. We bootstrapped it. We all lived in this gross little row house in Cambridge, in Boston. And because we bootstrapped it, we had no money. And because we had no money, we tried to DIY everything. And in particular, I bought a copy of double entry bookkeeping for dummies or whatever, and QuickBooks Desktop 2009. And I did our accounting in the first company. And in doing that, I think 2 things became very painfully clear. One was wow, this is super shockingly manual and error prone and tedious. And it's it makes no sense that this is how people do this. We know about computers. Computers can actually do a lot of this stuff in a way that is strictly better than the person would, was kind of insight 1. And then insight 2, which actually didn't come to much later, was look, as a founder or as a business owner, I don't want a piece of accounting software. What I want is a trusted partner who's going to own this for me. And so really the reason we started building this is because this is what we wish we could have hired in our first startup. And then in our second startup, we did hire an accounting firm. We did hire a tax prep firm. We were a bit more established. We had some more money, so we could bring in experts to do this stuff. And we were just unsatisfied with the quality of the experience. These folks didn't get startups. They were used to working with the business down the street, and everything about the way the engagement was structured, from the technology they used, the questions they asked, how they operated, reflected the fact that they just didn't really get it. And so we're fine, we just need to build this. And not to take you too far down the rabbit hole, ultimately, if we're going to talk about sort of what is the multi-decade ambition, again, when we started our first company, we knew nothing about anything. Literally just didn't know anything about how to run a business.
You were just a bunch of nerds, basically, that could code really well.
Computer nerds from the computer club. And we're oh, we have a cool technology. Let's build a business. And I remember meeting with some of our advisors and being how does one do sales? What is sales? How do you employ a person? And the point here is there's this whole body of back office work. And the back office work is important. It's obviously important, or big companies wouldn't spend zillions of dollars employing tons of talented people doing this work. So it's important, but the average business owner doesn't know how to do it. It's not their area of expertise. It's not a super high leverage use of their time. And our thesis, or kind of the ultimate belief, is, well, it doesn't make sense for everyone to be reinventing this stuff for themselves and kind of cobbling it together from first principles. There should be an obvious back office provider that does all of this stuff for you. And all of this eventually for me is accounting and legal and HR and IT and business insurance and lending and finance, just all this stuff. Now, obviously that's a very, very big problem. We're starting specifically with the problem of accounting. But I think the insight here is, if you think about AWS as a great example, AWS's pitch is essentially, let us run your entire technical infrastructure. And when we do that, you're going to get capabilities that are better, faster, cheaper, more interesting, more secure, whatever, than had you done it yourself. And our pitch is basically, again, in the limit, our pitch is, well, listen, we want to be that, but for your back office. Like, why are you thinking through, like, we already know how to do it. We know how to do it at scale. You can get all the benefits of the scalability we have. And that's like a very big, meaty problem. And like, to get philosophical about it, like, what is the ultimate ambition there? Well, if we can really take this stuff off your plate and we can do it better than you would have, we will hopefully be making your business more successful. Both because one, you can focus on the specific thing you're really good at or that's really high leverage for you. And two is like, we have all this insight and data from the scale that we operate at. We should be able to do it better than you do it yourself, even if you are a super smart, talented person, which, you know, as a listener, of course you are.
I've heard you say it was a mistake to do it yourself. It's also a good thing that you did it because now you're here. You almost unlocked innovation at different parts of the economy by solving this like pretty boring problem for a lot of people.
Totally. And I think the important thing is like, I wish it weren't important, because if it weren't important, you would just not do it at all. And then it like wouldn't consume any mental energy from you. The challenge is it's important. It's important that it be done right, but it's not a high leverage area of expertise of you, the founder. Like, of course, you should leverage an expert to take that stuff off your plate. And again, I think this kind of goes back to this idea that there's no bonus point for doing it yourself or for like being creative or like doing something unorthodox. Like, look, there is an obvious sort of best in class way to do this. You should lean on the experts to get it done, because to your point, like, you should be focusing your energy on the thing that's really going to move the needle for the business. And I think that's just like good life advice, in addition to obviously hopefully being a reason folks use Pilot. It is also a reason not to, as an example, run your own email server or like reinvent like best practices on org structure or whatever. Like, it's hard enough to make your core thing work. Probably you should lean on experts for anything that's not your core thing so that you can kind of keep that energy laser focused.
I'm trying to think of a reason to do your own accounting. Like, maybe if your whole business was something related to financial engineering and doing it yourself, you figured out a way to do your financial engineering faster or something. Then when you really step back, it's like every publicly traded company, you need a third party to like verify the accounting anyways. Like, I think it's pretty tough to really say you should do something like this by yourself.
In general, for the choice of like DIY versus use someone else, I think the question I would have is like, are you going to get 10x better outcomes doing it yourself? If so, fine, maybe you should think about how to do it in-house. Like, I guess I would argue you should not outsource like the core, like thinking about what product you're going to build, because yes, you're going to be able to do that better than someone else. I think for areas that are low leverage or do not obviously drive key business outcomes, if you can get someone who's an expert to do it instead, like, you totally should. Now, the other realistic constraint is, well, maybe you can't afford it. Like us in the early days, you know, eating ramen in the crappy house in Cambridge, like, fine, maybe that was a fine time to DIY. I think my pushback on that probably is like, it also depends on how much you value your time. And I suspect founders are probably undervaluing. If you could spend that incremental hour or 2 hours or 5 hours or whatever, like getting that next sale or, you know, hiring that next engineer or whatever it is, that's probably a better use of your time than clicking around in QuickBooks.
And then even just accounting for your business, it's like a $60-70 billion a year market. It's a pretty big opportunity, accounting alone.
Oh, totally. And that's sort of why we're still like, again, I would love to be doing the like very ambitious 20 plus year vision stuff, even just the core kind of accounting stuff we do. Like, again, and this is like a little bit investor catnip. It's like, well, who has the problem? Literally every business. How badly do you have it? Well, it's kind of legally required.
Yeah.
And how expensive is it? Well, the alternative is like, I hire a skilled accountant who has an office down the street and, you know, I pay them thousands of dollars per month. You multiply all those numbers and yes, like the TAM is basically infinity. And so the question is, well, cool, that's great. How do you actually tackle that? And importantly, how do you tackle that in a way that is actually super high quality for the client? Because if the experience isn't good, then you might as well just go home. That's kind of the whole point.
So you said you met all your co-founders at the computer club at MIT. Well, so how did you meet? And then I guess just throughout the process of deciding to start a company, how did you know they were the right people? Were there certain things you were kind of thinking about, or how did it play out?
So literally the way we all met is that we were all members of this computer club at MIT. And I was in classes, I think, with some of the folks too. Like, there was that the computer club was kind of the main thread, but also we had like done some group projects together. We had taken some computer science classes together. We knew each other socially. I would say we were friendly. And I think that's actually a very good shortcut in the early days, in the sense that like, if you think, first of all, like founder drama or like incompatible founders, that is a leading cause of death of early stage companies. And so how do you kind of mitigate that? Well, the way you mitigate that is by like knowing that you work well together with these folks. And so the fact that we had worked together on projects together gave us, I think, confidence that, okay, sure, we should embark on this, on this journey together. Like, what should you look for in potential co-founders? I don't think we were that principled about this when we did it. We probably just got lucky, if I'm being honest. But I think ideally, what I would be looking for is like, one, compatibility, that you're going to be able to work together. Two, ideally, and we didn't have this, non-overlapping areas of expertise or non-overlapping areas of ownership. Like we all had studied computer science, so the backgrounds were not like that diverse in this particular case. But we, I think, pretty rapidly differentiated into our different focus areas. The third, and this is kind of obvious, is obviously mutual trust and respect. Like you're going to be working with these folks for a long time. If it goes well, there will be times when it's going great. There'll be times when it's going poorly. Like having that foundation of like, we think the other people are good, we trust them, and then we just communicate well.
So this first company that you started, HSpice, what was it? How did you guys come up with the idea and how to get started?
Yeah, so it was my co-founder Jeff's master's thesis at MIT. We had some technology that could update running systems without rebooting. I'm sure you've seen that pop up. It's like, oh, you must reboot to install new updates. We had some tech that could take those updates and essentially magically transform them so we could apply them on the system while it was running. And this actually was very much a kind of personal pain point for Jeff, which is why he kind of did the foundational research. He, in particular, was running these server systems at MIT, and a software update came out. He said, okay, I'll schedule the outage window for Sunday at 3 a.m. and I'll come in and do it or whatever. And the update was announced on Wednesday. And between the Wednesday and the Sunday when he was going to apply the update, a hacker took advantage of it and broke in and compromised the system. And the pain was like, look, you want to apply these updates right away, but you don't want to incur kind of the downtime or cost of doing that. Like there's got to be a better way. So he had developed the tech. And again, we were super unsophisticated about how we thought about companies. But we were like, this seems cool. Like we like this. Surely other people will want this capability too. Like, let's try to do a company around it to get it out into the world. And again, I think we did not really understand what that meant. I don't think we were very sophisticated about what is the market size? Who's the ultimate buyer? How do we go to market? We didn't, I don't think we really thought about any of that stuff. We were just like, this seems cool. Probably people will want this. Let's give it a shot.
You've said before, you spent a ton of time doing things that felt like, work or felt like they were productive, but they weren't. Can you maybe touch on what those were just for people listening so they can maybe, catch some of those things earlier in their own journey?
Yeah, totally. So one of the great things about being a founder is, you're your own boss. One of the worst things about being a founder is you're your own boss. And there's no one is telling you what to work on. And the danger of that is that it is very easy to fool yourself by working on things that just don't matter. I think it's like you're not going to just goof off. You are a smart, talented person. Oh, I probably shouldn't be playing video games. I should probably be working on making my company successful. The idea of work versus I'm not working, that's very clear. I don't think the average driven founder simply doesn't put in enough hours or whatever. I think the issue is they probably just work on the wrong things. And what do I mean by working on the wrong things? The most tempting stuff or the most dangerous stuff to work on is stuff you're good at or stuff that you enjoy that doesn't matter. If the thing is priority number 27, but you happen to like doing it or you're good at doing it or you're procrastinating doing the hard thing by doing that other thing instead, that's dangerous because you feel like you're working and you are doing stuff, but it's just not actually pushing the business forward. I think the very, very classic example of a great way to waste time. And look, this is all a generalization. You should take everyone's advice with a serious grain of salt, but basically going to conferences, unless you're there to actually find and sign customers or recruit engineers or whatever, it's probably just a waste of your time. And you feel like you're working. Oh, I'm at a conference. I'm networking. I'm listening to talks. But is that really going to make your business more successful? And maybe the more pointed question, is this really one of the top 3 things you must accomplish this week to maximize the probability that your business is successful? The answer is probably no. And I think that's uncomfortable for people to grapple with because yeah, the thing they need to be doing is hard and unpleasant. And so you don't want to do it.
Yeah, I feel like with a conference, there's a lot of ways to get trapped into thinking that it's work, it's productive, etc. The people that I feel say that conferences are productive, they are very intense about how they approach those. Like they make sure, like if you're speaking on a panel, there's benefits to that sometimes, and making sure you're getting the right kind of benefits. Usually there's a concentration of your customers or investors or your peers where, again, it might be super efficient. You can go to a dinner with 8 customers all at once. You spend 90 minutes and you have 8 customer conversations. That can be super efficient. But like if you don't have a product yet and you're not selling anything or something, maybe that might not be worth it yet. So it's almost like the order of operations, I guess, of when you might approach something like that. I've definitely heard that before conferences. I've heard people say they're really bad, and I've heard people say they're really productive.
Well, again, I think it depends on the framework I'd have is like, look, what is your top priority? Maybe what are your top 3 priorities? And is this the most efficient way to move the needle on said priorities? And like, for example, if you have a product and all of your customers go to this thing, it can be a very efficient way to acquire the customers. If you like have a booth or whatever, like there are ways to make it valuable. There are also ways to just make it a giant waste of time. And so I think the thing, and we didn't do Y Combinator, so this is all third hand. I think like one of the pieces of like Paul Graham's advice from one of the essays is like identify your key metric and like make it grow X% week over week. And if you're just like laser focused on like making that number grow 5% week over week, first of all, compounding interest, exponential growth is an amazing thing, but also that like really forces you to have clarity around, well, is the thing I'm doing right now actually going to move that metric? And if not, why am I doing it? Or maybe I should like step back and say, well, is there a different thing I should be doing to make that metric grow?
So then in terms of HSpice, what was the process with that company? What happened?
So we bootstrapped it. And I think that was super healthy because it meant that we couldn't spend money that we didn't make by selling something to someone who wanted to give us money for it.
Did you have any customers or how did that work?
Yeah. So we won a business planning competition in the early days, and then we got a government grant, which I mean, it was helpful for us. I don't necessarily recommend it. It depends on the business. So we had like a little cash infusion initially, but like not a lot. And then we basically made a subscription service. We basically said, when these updates come out for Linux, we're going to go prepare the rebootless version using our magic. You can subscribe to that. As soon as these updates come out, we'll send you the versions that you can apply on the systems without rebooting. And then we sold that as a subscription. And the people who, interestingly, in this, I don't think I would have anticipated this, on a whiteboard or whatever. We initially thought like, oh, who really needs this? Like Morgan Stanley or like Visa or like the places where the downtime is so expensive and they care a lot about security and da-da-da-da-da. And that's true. They like very much did need this stuff. But they were totally unwilling to buy it from 12 randos in the gross house in Cambridge. They wanted to buy it from the operating system vendor. And so the sweet spot, as it turns out, of people who really badly had the problem and people who were also early adopters for us, for this particular business at this particular point in time, was the web hosting industry. There were, in 2009, there was a long tail of providers that would like host your WordPress website or your blog or your online store or whatever. And they all basically had the same configuration. They all ran Linux. It was just like a very commodity setup. They were really differentiated on brand. But they cared a lot about security because lots of people were logging into these systems all the time. If they weren't up to date, they'd get hacked. And they also cared about availability because like you were paying them to run your online storefront and you were annoyed if that was ever down. So we actually we got a lot of really, really like good traction in the web hosting industry. And we did the company for about 3 years. Oracle ultimately acquired it. We can talk about that in a second. But I learned so much about the web hosting industry. And at the end of like doing the company, I was like a B-list web hosting industry celebrity. Like we would go to these conferences, but we would have a booth. Like the goal was customer acquisition. We'd have a booth. We like had leads targets. It was always ROI positive, which is why we did it. And like people were like, oh yeah, it's Waseem from HSpice. And I knew all the like web hosting industry players. And like we were just like super, super in the weeds on like a really niche-y part of the world.
Yeah.
And I think that's huge though. I think like you want to find that like niche that like really desperately wants your thing and is willing to buy it now. I think that's like a critical lesson for any business.
What's the secrets then to a good conference and getting ROI? Can you talk us through that?
So for us, we had a very specific objective. We were like, we want to get more customers. And we had a very good sense of who our customers were. It's these web hosting companies that run Linux, because our thing only worked for Linux, of, a certain size or whatever. And then we're like, well, where do these people hang out? And there were like two big conferences that they like went to every year. There was one called Web Hosting Con, which we exhibited at every year. And there was another one. There was a popular software product called Parallels, which was like a web host. It was a thing that web hosting people used. They had a conference as well that we exhibited at. And then we would exhibit at the Red Hat Summit, which is Red Hat was a Linux vendor. The venue was perfectly targeted to like our customers were actually there. So step one is like, you got to make sure that like the right people are there. And then you have to have some way of engaging with folks. So we had a booth, and our whole thing, I'm still very proud of this. Our whole pitch on the booth was like, it was like retro themed. Our giveaway was like these old floppy disks, like the big, like 5.25-inch floppy disks. And the tagline was like, you're not still using floppy disks. Like, why are you still rebooting for updates? And that like deeply resonated with this target audience, because the buyer was like the IT admin at like these web hosting shops. They were nerds like us. They were like, oh, cool. Like, I do want this vintage floppy disk. And then they're like, that was the hook to get them in. So you have to have like a booth. The booth needs a hook. And then you need to really like engage with folks as they come by. This sounds obvious, and it's surprising how many people don't do this at trade shows. You have to be like, when you're aside, when you're like walking down the street and then there's the person from like Greenpeace or whatever, and like they really want to talk to you. And like you're kind of trying to avoid them, and they're very good at just like engaging you. You kind of have to be that person. First of all, it's a super hard job, by the way, and I like have deep respect for the folks out there that are doing it. People are going to walk by your booth, and you need to draw them in. You're like a kind of like a old-timey carnival barker. You're like, oh, would you like a floppy disk? Oh, what are you doing for updates? So you really have to like, there's an art to doing it well. It's not easy. It's tiring. You're on your feet all day. But if you don't do that, like it's not going to be a successful conference for you.
So it's basically make sure your customers are actually there. Make sure you have something that gets their attention and a reason for them to talk to you. And then you have to actually talk to them and engage them and
you have to actually
get them excited. Yeah.
You then also need to follow up with them. Like, it's not good enough to have captured the lead. Like, fine, you scanned their badge, you got their business card or whatever. Now you need to then call them promptly and be like, hey, remember, I spoke at the booth about how you might want HSpice for your web hosting company. Like, here's how you get started. Like, you have to actually complete the, close the loop on the motion.
Basically, you need a plan when you go in. You need to be active and execute the plan.
This is kind of what I'm saying, which is you have to go in with that like laser focused intention. Otherwise, literally, you just wasted a bunch of time and money.
Your first ever meeting with the VC was in June of 2008. How did it go?
Terribly. So again, we didn't know anything about anything. And so like, we didn't know how venture capital worked. We didn't know like whether it was an associate or a principal or a partner or whatever. We were just like, oh, there's a venture capitalist. We have a startup. Like, we should talk to them.
They're gods. Like they bend the will of the industry towards you, and they make you successful.
And I think I'm trying to even remember like what the setup was. It was like maybe there was a talk, and then like a bunch of people like went out to dinner with the person later or whatever. And I made sure that I was like sitting right by the guy, and that I like had a chance to like pitch him about HSpice and what we're up to. And then I like followed up with him via email. I was like, hey, really good seeing you at the event. This is what we're doing. Like, I don't know if you guys would be interested or like what, because I had no idea how this works. And he wrote me back. He was like, look, and props, this is not a literal quote, but this was the gist of it. The quote was basically like, look, ordinarily we just kind of like string you along just to see, just in case you like did something interesting. In this case, given that we're like in a global financial crisis, like I'm just going to tell you no, like there's no way we're going to invest. And I was like, okay, well, that's cool. I mean, I appreciate it. I appreciate that you didn't waste my time on it.
I guess what you know now, this is 15 years later. How would you suggest 2008 Waseem approach something like that? Or how would you suggest a founder today approach just, new investor relationships, maintaining them, convincing them to make a bet on you?
Sure. So this is annoying advice because it's not very actionable. The easiest way to raise money, or the best way to raise money, is to not need to raise money. Because like, it's not that it's about leverage, but like, I mean, kind of you tell me, Turner, like when you look at companies, what you're looking for probably is like indications that it's working. Traction or revenue or growth or whatever. You can't really like fake those things. And so in some ways, like one weird trick for like successfully raising money is like have a business that's doing well. And if you have a business that's doing well, like you probably have other options. And so that like the easiest way to raise money is not to need to raise money.
You want to look like a good investment. Like you want people to want to invest in your company. It's so simple, obviously very much easier said than done, but
I think people get like the cause and effect or whatever a little bit confused here. The point of the company is not raising money. Like raising money is a necessary evil for a certain type of company on the trajectory to hopefully being like a large multi-billion-dollar iconic enduring company. And the causality there is important. It's not like you raised money, therefore it's going to work. It's like, well, it seems to be a necessary but not sufficient condition. Like if you look at the history of the vast majority of, these iconic enduring public companies. So I think my first piece of advice is like, don't fetishize venture capital. Like maybe you don't need to raise VC. Like maybe you should focus on like building a successful business. And like we walk the walk on that too. Again, our first company was Bootstrapped. It was acquired by Oracle. Like it was a life-changing financial outcome. And actually it was a financial outcome that was more meaningful than it would have been had we raised venture capital. I think it would not have been possible or would not have been as interesting. So one is like, ask yourself, well, do you really need to raise venture? And then if you do, and I think certain businesses do, and obviously I think Pilot is an example of such a business, or we wouldn't have raised like $160 million. Like there's a reason we've raised what we've raised. It's not to like make me feel good. It's because we think the capital is needed to allow the business to be as successful as we want it to be or to achieve the ambition that we want to achieve. Then it's like, fine, if you think that is in fact the only way to do your business well, then okay, yes, like you're on the venture path. And how do you make the venture path work? Well, yeah, it's about like demonstrating that you are progressively de-risking the risk factors of the business and that it's working in the ways that you said it would work. And that like the ultimate outcome will be an interesting one if things continue on the trajectory that they continue. And so ultimately in the earliest days, when you have nothing, you're basically trying to get someone to bet on the team. That's hard if the team is totally unknown. But if like the team is known or you have prior expertise or whatever that is like intriguing to certain investors, like that helps. But the unfakeable stuff is traction, right?
I thought of something really, really good thread we could have gone down, but totally lost it and all that.
Was it about VC or not VC?
I would think about in terms of raising venture, it's like you really should only do it if it increases the chance of being successful and hitting that outcome. Obviously, there's times where it will actually, in my opinion, it will reduce the chances of success for you personally as a founder. You should really only do it if it helps you build a better business. And there are a lot of cases where it doesn't, but there are cases where it actually can and it can help.
And it's just like, it's dangerous. Your burn rate never decreases. Like it only ratchets upwards. And so when you have money, you spend money.
Yeah.
And you get accustomed to spending money at a certain way and operating the company with a certain efficiency or, with certain expectations. And it's very hard to change that. And if you in fact can build the thing in like a super scrappy, lean, profitable, bootstrapped way, you're kind of invincible. Like no one can stop you. Whereas if you become addicted to like, well, our burn is XYZ, a month and like there's nothing we can really do about that. Well, if your ability to access capital like dries up, you're in a pretty tough spot.
Sometimes it can be hard to appreciate it. I guess if you've never just walked through it all and seen all the scenarios of like owning 100% of something can oftentimes be a much better outcome than owning a small percent of something big, or sometimes owning a small percent of something big can actually be the best outcome too. So it's like you really need to think critically before, and signing up to raise venture, it's not like a 2-year thing, right? Like you're probably signing up for a pretty long journey. So I think you need to make sure that those expectations are aligned.
Oh, I totally agree. And I think that like, to your point, I think it's probably in the grand scheme of things easier to build a $10 million company that you own 100% of than it is to build a $1 billion company that you own 1% of. And those like the financial payout in kind of both those cases is the same. But one I think is like it's a different road. It's a much harder road. But to your point, it's potentially also like at the extremes more interesting, but it's like a lot higher variance.
Maybe the financial outcome was exactly the same in both scenarios, but the impact that you had on the world, like it was the way going down the venture path, you had a huge, significant positive impact on a lot of things for a lot of people. And maybe it was worth it too. So there's a lot of different lenses to think about it.
Like importantly, the money can't be the only reason you do it. Like if your goal is purely to, acquire wealth, you should just be an anesthesiologist or something. Or I don't know, like, work on Wall Street or whatever. Like,
yeah.
There are probably like lower variance paths to accumulating like really material amounts of money that are not starting a startup. Now, look, I'm not saying the money doesn't matter. Like, of course, it is capitalism. Like, it is obviously a powerful motivating factor in the world and in the motivation of folks who do this. But I think it can't be the only reason. I think you have to really like either be excited about the team or the craft or the problem. There's got to be something that like gets you up on the days when it sucks, because like there are always days when it sucks.
Yeah, it's not like it's easier, right? Like you could probably go down the 9 to 5 track and I don't know, maybe you're not going to be a billionaire. And whether or not that's important or not, going down the path of doing a startup, like you're signing up for probably a little bit more stress, more work, more challenges. And maybe that's actually exciting to you too. Maybe that motivates you. Like for me, I don't like being bored. Like I like working on stuff that's really hard and, trying to figure things out. So startups can actually be more fun, even if it's harder.
I mean, I think the two statements that are seem in conflict but are not are like, one, it sucks, and two, it's like the best job I've ever had. And like those are both true.
So you touched on something, you talked about getting acquired by Oracle. How did that kind of come about? Like you're a first-time founder, you've got this business that works really well within this niche industry. How did you get acquired? What's the process? How did it happen for you? And then what's a framework to maybe think through for other founders?
One of the kind of common misconceptions is like you wake up one day and you're like, I want to sell the company. And then you like go and find a buyer for it.
By the end of the day, you've just, the company sold. It took a couple of days to get it all done.
Right. If only it worked like that. My experience has been, and we've sold 2 companies, one to Oracle, one to Dropbox. My experience has been that companies are not sold, they're bought. Like there has to be something that piques the interest of the acquirer that makes them interested in acquiring your company. And the problem with that is you don't have any visibility or control of that. One day Oracle woke up and was like, yeah, we want to buy HSpice basically. And I don't think we did anything in particular to cause that to occur. And I think I even asked, like once we were there, I was like, why? Like, why did you guys reach out to us? What caused this to happen? And we had met with them like 2.5 years prior or whatever to like show them the tech. Like they were aware of our existence. And so like, what changed between, like that meeting in 2009 and like the letter of intent in 2011 or whatever? Like, I don't know, stuff internal to Oracle that I have no visibility into, What I think of as like actually interesting outcomes for technology startups, and those are important caveats. The companies are bought, they're not sold. And so the question is like, fine, like what causes that to occur, or what are the range of potential outcomes there? Is like, well, I think the acquirer is either interested in the tech, the team, or the actual company. And, the outcomes you're going to get are going to be pretty different depending on what the answer is to those questions. Like in the case of Oracle, in a way that I think was probably a mistake, because I don't think they realized how good the team was, they were really quite interested in the tech. They were like, we want this capability for Oracle Linux. It will be a way of differentiating ourselves from the other Linux offerings out there. Like that was the compelling thing. In the case of Dropbox acquiring Zulip, I think it was principally a team-oriented acquisition. It's like, well, we know that these are talented engineers. We're in a really kind of growth phase with the company. We want to kind of slurp up as much talented engineering as we can. Like we know these folks are good. That was the thing that motivated it. And in both of those cases, again, like I had no visibility or control into like Oracle's views vis-a-vis the other Linux vendors, or exactly how many engineers, Dropbox happened to want to acquire, wanted to add to the team in like April 2014. Like those are factors that were kind of like totally outside of my control. So I think a lot of this is just like, I think trying to engineer your business to be acquired like is kind of a mistake, because the way to like, it's kind of like the investing thing again. It's like, how do you make your company an interesting acquisition target? Well, build something that's interesting and doing well that you don't want to sell. And like the fact that it's doing well is the thing that will potentially be intriguing to potential acquirers. And like the flip side of that too is like, if you're really trying to build something to be sold to a particular company, again, you don't really control like what their level of interest. It's like a very difficult timing problem. So I generally advise people like if your goal is to build it to flip it, I think it's hard. I think it's really, really hard because you're building for a very niche buyer who will only buy like when circumstances that are unknown to you like come true.
Yeah. So it really just comes back to build a good business, create a product that people want to use and pay for, and hire really talented people. And that all goes into making a good business.
And that's like such unsatisfying advice because it's like, it doesn't feel like very actionable, but I think that's the truth, which is like the way that you become an interesting acquisition target is you build a thing that is independently valuable. And in some ways, the litmus test, it's a little bit like, the Groucho Marx, like, I don't want to be part of any club that would have me as a member. It's like the way that you are like interesting to be acquired is to like not want to be acquired. Like if it's going well enough that you want to like keep operating the business, that's probably the thing. Like the reasons that you don't want to sell are probably the reasons that acquirers are interested in potentially scooping your company up.
So you just hinted that your second company was also acquired. What was it? Like, how did you guys make that transition? Got acquired by Oracle? What was the journey from the acquisition to then starting the next one?
Yeah, so the second company, so we were at Oracle for a year and a day to transition over the tech, and like that was basically what we'd agreed to when they acquired the company. We left and we all got together in my co-founder's apartment and we're like, okay, we want to do the next company. Like we knew, I think, immediately that we wanted to do something again with basically that same founding team. The second company was a group chat tool for businesses. It was kind of like a Slack-like product at a time when Slack was still making a mobile game. The state of the art at the time was like HipChat or Campfire or IRC. It's like it was clear to us that there was opportunity in like a business or workplace focused group chat tool at a time when actually like the average venture capitalist investor was very, very skeptical of that hypothesis because lots of people had tried and failed in the space. So I think we did a great job identifying the market opportunity. Obviously, like we didn't do a Slack level job on execution or like it would have been Slack.
This was 2011.
We started the company in 2012 because HSpice was acquired in July 2011. We were at Oracle for a year. So by July 2012, we started, the company was called Zulip. So we started Zulip in like August 2012 or so.
And then to your point of, VCs were a little skeptical about whatever. As a founder, I don't think you should definitely be able to absorb the perspective or take the perspective, but VCs are wrong all the time. So I wouldn't necessarily take that as the word of truth, whatever they say or think.
Yeah, I totally agree with that. I think the other thing too is like the bar is not you have to convince everyone that it's an investable idea. The bar that you have to clear is that you convince one person to take the bet on you. And in fact, if everyone universally thinks it's a good idea, it's actually like probably not. If it were so obvious, like why hasn't someone else done it? It's like why it should already exist if it is super clear to everyone that like, of course, the world like is going to be this way. There's got to be something structural that has changed recently or that is a barrier to make it make sense that it doesn't already exist.
It leads to some interesting challenges as a venture capitalist when you are trying to convince whether it's other people at your firm or your investors that you should invest in some crazy idea. And you kind of have a limited amount of time for it to actually kind of start working to where people will start to doubt you. So it can be tricky sometimes to go against the grain as a VC. But that's how you make money. Like that's how you be a good investor. So it's a tough space. You're kind of a middleman really at the end of the day. And you provide a commodity basically. Maybe it's not quite a commodity anymore, but you're just giving money. You're basically selling money to the people that don't need it at the end of the day.
Well, and that's the thing I think that's tough, which is, the consensus bets are presumably like also bid up super high because everyone thinks they're good and so everyone wants to invest. And it's like the like frustrating challenge of the early stage startup is your idea is bad, is indistinguishable from your idea is amazing and it's just early. It's like you actually can't tell in the early days whether this is just like totally going to fail or going to be super successful because in the early days, they have a lot of the same characteristics.
Let's say you're a founder in that intersection where no one outside will fund it, but it is a good idea. And it will work. How do you figure that out as a founder?
Well, that's the challenge, right? Which is the two attributes that you need, and they're like very incompatible, is like you need to be a sober realist and you need to like pivot or whatever if the market is telling you that it's like that it doesn't want it. But you also like have to have conviction. In the early days, every idea seems bad because the reasons that it is bad are so obvious and the reasons that it's going to work are kind of non-obvious or are certainly unproven. There's this like, everyone has heard this clip. There's like a thing from Ira Glass about like why it's so difficult to like create. And I think in his case, he's talking about like writing or like, hosting radio shows or whatever. He's like, as a listener, you're so attuned to like what good looks like. Your inner critic is very good at judging like, is this good or is this crap? But your like inner creator in the early days, like it's going to be crap. Like you're going to produce stuff that is bad because like you don't know how to do it yet, or you haven't yet kind of like provided that polish. And I think that same thing is true in the early days of the startup. It's so easy to list all of the myriad reasons that it's not going to work. And those reasons are like probably right. Like statistically, they're probably correct. So at some point you just kind of have to like hunker down and be like, well, no, I'm really going to give it a shot. I'm really going to kind of like give it a good college try to see whether there's something there.
Yeah, you kind of need to find some secret that actually is true that no one else has found yet. And you need to make sure it converts quickly, or at least be able to stick with it until it converts and becomes like a well-known truth amongst whoever it is, different stakeholders, whether they're customers, employees, investors, whoever interacts with your company?
I think for me, I like, some people don't like this, but I really like the why now? Why doesn't this already exist? Because the reason it doesn't already exist is probably not that no one has had the idea yet. Like, to take it back to pilot, you and I were talking about this before the show, accounting has existed for forever. And double entry accounting, since the 1400s or whatever. The idea that there are people who do your accounting, it's literally one of the world's oldest industries or jobs. And even the idea that maybe computers can help do accounting. I think one of the first applications of computers was doing stuff with numbers. QuickBooks has existed since the 80s. The idea of maybe we should build an accounting firm that could service every business and use technology. That's not a novel idea. We were not the first people to kind of come up with that idea. And so the question is well, why doesn't this already exist? Or maybe what has changed to enable this to exist now in a way that it was not possible, 5 years ago, 10 years ago, or whatever. And in our case, it's actually the underlying ecosystem has shifted a lot in two ways. One is everything is cloud-based and has an API. When we started our first company in 2009, Stripe did not exist, Gusto did not exist, Brex did not exist, Mercury did not exist. None of Plaid did not exist. None of the foundational stuff existed. Your bank statement arrived in the mail and you opened it up and typed it in or whatever. You would have had to build all of those building blocks to be able to then do pilot. So one is there's a bunch of infra that now newly exists, comparatively speaking, that did not previously. And the second, I think, is a really profound shift in buying behavior, which is that the buyer 10 years ago even probably wanted to take the shoebox of receipts and go down to the office, on, Broad Street or whatever, and meet with your accountant and talk to them.
Yeah, it was their buddy. They were catching up, just doing the books, talking about fantasy football or whatever the people talk about.
Yes. Or they'd take you to the baseball game or whatever. And I think increasingly, and it's accelerated by the pandemic certainly, but even true before then, is no, I kind of actually want to transact this online. I don't really want to go there. I don't really care that you, my accountant, are not going to show up at my office. I'm comfortable enough with the internet that I'm okay with the idea that Pilot's accountants in San Francisco and Nashville are doing this stuff for me.
I've seen all these different numbers. How many customers publicly do you guys say that you work with at this point?
It's about 2,000.
About 2,000. Okay. So you probably have a pretty big team. I don't know. Do you know where you would rank in terms of sized accountant? I know they have the rankings on size. Where would you guys be on that list?
I mean, definitely for startup focused accounting firms in the US, we're the largest on, I think, literally every metric, on employee count, on revenue, on customers. And that's not because we're geniuses or whatever. It's, I don't know, maybe. It's because structurally, the average accounting firm is not built to scale and in fact has huge diseconomies of scale. The reason that there is not a gigantic, accounting firm, there's a surface area to volume problem. It's actually just hard to do good work at scale. And the only reason we can do it is because of the technology forward approach, which is if you have the core mechanical error prone stuff done by the computer, then your awesome accounting team can focus on the stuff that actually makes the experience really good in a way that allows us to support as many customers as we support while still keeping a super, super high bar for the quality of the experience.
So how does that play out in practice where, let's say, you can just serve a startup customer faster or more efficiently than, a traditional accounting firm?
The place we've really been focused is really not on can we produce the profit and loss statement for you faster? It's really, can we actually scale with you as you grow in a way that other people can't? And so we have you can start with us on the baby plan, basically, which is super high value. It's very budget friendly. It's just going to get you the basic stuff you need for us to be able to do your taxes. And in case you're an investor or landlord or whoever wants to see the books. And then as you grow, we can layer more stuff on. You need some fractional CFO help. We can pull that in. Oh, you need help with AP and AR. We can pull that in. Oh, you need help with the R&D tax credit. We can pull that in. And I think that sort of broad-based ability to grow with you is a direct function of our size, which is in turn a direct function of the approach. And so the biggest, and I'm not giving ourselves enough credit here. I think the biggest benefit, the fact that we do things differently, is that we can do it for more folks, which means we've seen the movie, which means we can make the experience better. Tactically, there's also some nice polished stuff we do. We have a little interface where you can correspond with us and you can connect up all your systems. And we have questions, we can ask you them, and you can download the latest version of the books. Like there's stuff we do to keep it organized that's not, fax me your bank statement or whatever, which is probably like what the old school accountant is asking you to do.
I've heard you say before that your weird structure actually gives you an advantage. Can you maybe explain why or how that works?
There are kind of two options. Naively, there are kind of two options that you'd take to pursue this business. One is you would be a tech company, like a pure play technology company, and you'd build a software tool that helps do accounting that I guess you sell either to accountants or maybe that you sell to the founders and it helps them like DIY. And the reason I don't like number one is I just don't think that's what the founder wants. Like I've never talked to a business owner who's been like, please sell me accounting software. I can't wait to like spend my Saturday evening like doing my accounting. Like, no, what they want is like, I want to know that you're taking care of this for me. And that when I have questions, I can go and ask you, and I'm going to get smart answers from someone who like knows about this stuff. So that's the reason not to go kind of pure software is like software does not actually solve the problem. To solve the problem end to end, you need to be willing to own the problem end to end, which means you need to be the accounting firm. Like you need to be the accountant. Because otherwise, you're just not going to provide as good as an experience as the person down the street who is willing to be the accountant because they are the accountant. The other approach is, you've built a traditional accounting firm, like a kind of old school, legacy style firm. And the problem with that is like, you're not getting any of the benefits of technology. Where the benefit of technology is not for any given customer that it's faster or more efficient or whatever, like that doesn't actually really matter to any one customer that like your internal economics are more interesting. What matters is like, well, the work is super high quality and it's done reliably and I don't have to repeat myself. And what that means is that our team is like not wasting their time like fighting with that broken bank reconciliation. They're actually spending that time like on a Zoom or whatever with you, answering your questions or like helping you think through, the strategy for your latest raise or whatever. Like it frees the team up to do more of the value add stuff.
I've heard you say too, about 95% of Pilot's software that you built is actually internal software for your teams. And I've also heard you say too, just in terms of if you're building this tech-enabled service business, you basically said don't do it, like jokingly. But is that kind of the way to do a tech-enabled service business? It's the same client customer-facing approach, but internally you build the software? Like, is that a way to think about it?
There's the problem with tech-enabled service is they're punishingly hard and they're very, very domain specific. The maybe briefest reason they're hard is the core thesis is like, look, there's some services industry thing. Maybe it's accounting, maybe it's legal, maybe it's recruiting, whatever. And the like legacy firms have their existing cost structure and their existing margin. Maybe it's like a 20% gross margin business or whatever it is. And your thesis is like, oh, I'll use technology and like technology will help drive up the margins. In practice, that's just really, really hard to do. The things that contribute to your margin being good or bad are like, how much you pay your people, their utilization, your billing model, like the effects of the economy generally. And then are you building things that actually like make the team more efficient? Or are you building things that just like, help out with workflow, but don't actually lead to more productivity? Or if you are unlocking more productivity, but then that's consumed by like, the training time of getting like new people to figure out how to use your tool. Like there are all kinds of ways where like the beauty of software normally is that like software has great gross margin because like the whole thing of software is you write it once and you run it as many times as you want. And the incremental cost for each like marginal copy of software is basically zero. And so you get a lot for free as a consequence of that. Like that's not at all true in the tech-enabled service. By default, your business wants to be the 20% gross margin, like legacy accounting firm. And you have to really be thoughtful about kind of exactly what you build and how you build it to get margins to be okay and then eventually to be good. It's the worst of both worlds in some ways. It's all the hard parts of a B2B SaaS company and all the hard parts of running an accounting firm.
Basically, you still have the same fixed costs, but you try to get as much revenue out of those fixed costs as you can. Is that a way to think about it?
I guess so. I mean, here's what I would really say though, which is like, if your goal is like, your view cannot be like, well, I'm just going to squeeze out, I'm just going to like optimize and I'm going to make things like a little bit more efficient. And like, that's why it's going to work. I think the only way it will work is if you believe that large, huge swaths of the work can be done entirely, eventually, entirely by the computer. Now, I didn't say 100%, but like big chunks. Because like making me incrementally faster on a task is just not going to move the needle that much. What you have to do is you have to take the task off my plate entirely. And then ideally you replace it with a task that is more interesting and more value add for the customer. So like if I can make it so that the software automatically does all the bank reconciliations or pulls in the payroll journal entries or whatever. And the consequence of that is like now my team can think hard with you about what you should be thinking about your budget for next year or whatever. Wow, that's interesting and differentiated and valuable. If instead the team is just like 5% more efficient, that doesn't really translate to very different kind of customer outcomes.
Question, do you have a hard stop in 20 minutes?
I do.
I guess kind of level setting, what was the moment that you came up with this idea of doing pilot?
So we had like in the first company when we did our own accounting, I like wrote a bunch of Python scripts or whatever. And we actually, in a way, again, horrible use of our engineering time. We like wrote a bunch of software to do a bunch of the mechanical work for us. And it was funny when Oracle was acquiring the company, you go and you meet with their various heads of integration. And one of the things that we did is we met with their head of finance and like describe like how you run your monthly close process, blah, blah, blah. We're like, well, we have these Python scripts and we run them and they just like do everything. And they're like jaws dropped. They're like, this is incredible. Like we're the most sophisticated financial technology company in the world. We don't have anything like this.
Yeah. Don't they sell accounting software also like NetSuite?
Yeah, they do. And they were like, why were you even doing your company? This is way more valuable than whatever it is HSpice was. Like this should have been the business. And we laughed about it and we ignored them and we did a whole other company like between then and now, basically. But that was kind of always sort of like on the back burner, like in the back of our minds somewhere. And then we did a bunch of very like white page, like just starting from scratch exploration when we started this company. We're like, what do we want to do? The first thing is I knew I wanted to work with Jeff and Jessica. So we like got in a room together. We're like, cool, we want to do another startup. Like, what is it going to be? We like did some exploration. We like bounced around a couple ideas. This one kind of came back to the forefront, which is like, oh, well, this is a pain we had ourselves, right? Like maybe we should just like go and solve it once and for all. And there was no day when we were like, oh my God, this is definitely going to work. We should absolutely do it. There was a day when we were just like, okay, let's give it a shot. Let's like start to kick the tires on it. And if it like is a real thing, it's a real thing. Great. And if it's not, we'll like come back to the drawing board and do something else. Basically, there are two components to the thesis, right? One is like, can you actually do the thing in software? And we already had a lot of conviction that we could because for a variety of reasons, we had like hacked together something similar in previous companies because we're technologists. We just had like deep conviction that we could actually make the computer do a lot of this work. And then the second question is like, will people go for it? In other words, can you actually attract and retain customers at price points that are reasonable? And so you kind of have to validate both components of that thesis to like feel like it's working. And the bigger unknown for us was like, will folks let Waseem do their accounting? And so in the early days, it was, I called up our startup friends to be like, hey, what are you using for accounting? Like, can I do your accounting? Like, I'll do it in QuickBooks. You should probably let me do it.
And this was 2017.
Yeah, this was like January 2017, basically.
Did you raise a seed round kind of just right out of the gate? Just, I think it was 3.3 million was the public number that I saw.
That's exactly right. Yeah. And it was basically like people from our networks. It was like investors and advisors of the previous company, like, and it was 1,000% a team bet. It was like, okay, the TAM is infinity if these folks can pull it off. It's a smart team. Let's have them give it a shot.
Yeah. And it was a lot different from that very first conversation sitting next to the VC where they didn't know who you were. You hadn't really, to them, you hadn't accomplished anything that they had known of. Like they didn't see this series of success. At this point, it was like, these guys, this is an amazing team. They've sold 2 companies. They're doing another one. We got to give them money.
Right. And so in that way, like people are like, oh, give me advice about fundraising. And it's like not very satisfying because I'm like, well, we raised money because like, for the past 10 plus years, we had been building credibility and connections and track record and blah, blah, blah. And like, that's why we raised our seed round. It was not the idea. It was, I believe in Waseem and Jeff and Jessica. And the idea is compelling if they can pull it off. Let's have them give it a shot.
Yeah. And you had a really interesting approach where you had 3 larger, I don't think you had a lead. You had 3 larger funds that all kind of did, I don't know, big checks, but they were probably pretty small for those funds. And then I think it was 40 angels. Can you just talk through that strategy and why you did it that way?
Yeah. I mean, the perspective in our previous companies is like, well, one, the reason to include the big folks is we wanted to audition them basically for the Series A. It's like, okay, at some point we're going to do Series A. We like want to know who like we are actually excited to work with or like what the working dynamics are like with these folks. So we like got them in. I think they were like $250K checks each. So very, very small for them, not like a super meaningful amount of ownership, but it was a way of building the relationship. On the angels, I think the thing that was interesting is in our previous companies, and we'd raised a seed round for the second company as well, it was very difficult to predict a priori, like which angels would be super helpful and like which angels wouldn't. And there was a person in the second company where like we almost didn't let them invest And then we kind of like sort of grudgingly did. And they were like the world's most value add investor, just like 100x more useful than anyone else. And so to some extent, the attitude on the seed round was, look, the folks on the cap table are people I would honestly pay money to get advice from. And I don't know how helpful they will all be or whether they will be helpful or not, but
they're giving you money.
Right. And they're giving us money. Like, cool, let's do it.
Is there a way to determine what investors will actually be helpful?
Not really. I mean, you could ref check, I think, with other founders that have taken money from them. That's probably the most bulletproof thing. The other thing too, and I think there is like a little bit of an inverse correlation between like how famous they are and like how hard they'll work for you. That's not totally true. The more unknown or unproven they are, like, they've got like a little chip on their shoulder about it in some way. They're going to work harder for you because they're also like, when you succeed, it'll build their brand. Whereas like, if you're some super seasoned venture capitalist investor, like, if Pilot is a successful investment of yours, it's like one in a list of like 100 successful investments you've already had. It's like not really going to move the needle for you.
Yeah, they've already had 16 IPOs. They're reading your updates from their yacht.
Totally. Now, that's not universally true. There are some notable exceptions to this, some very notable exceptions. But like, I find that like the hungrier, scrappier, earlier stage investors, they just like have more skin in the game. And I think that's actually good because you want someone who has deep conviction. You want someone who's going to like hustle hard for you.
We've already talked a bunch about the product development process, but how did you prioritize what you added next to the product? Because you've talked about, you started with maybe bookkeeping, but if you go on the Pilot website now, there's a lot more that you do. How did you figure out what to add next?
Very, very, very customer driven. Meaning in the early days, all we did was bookkeeping. One of the main reasons that folks didn't buy is that they'd say, cool, I'm sure bookkeeping is great. I do need bookkeeping, but I also need tax prep. And like this person over here will do my taxes too. Or, actually tax is the real reason I'm buying. I like need that at scratch first. So then we added tax. And then we would like lose customers would outgrow us and they'd switch to firms that had like a fractional CFO arm. It's like, well, look, you're doing a great job with the accounting, but I really need help with budgeting or forecasting or whatever. And it's like, okay, well, I guess we need to like layer that on as well. All like 95% of the stuff we have built has been very, very like pretty directly responsive to customer demand, either in terms of explicitly what they're asking for or implicitly like they're leaving Pilot because they can't get X. It's like, fine, well, let's figure out how you can get X so we can grow with you.
You guys obviously were successful. You did a good job. I think I remember seeing a number you said something like every year the company tripled in size for a couple of years. 1 year it doubled and then tripled again in size. So at one point, one of the investors in the seed wanted to preempt a Series A. That's what you hope for, right?
Yeah, I mean, I think it's like, it's like your job as the investor sort of like to identify like, is it working? And you have, since you were in the seed round, you sort of had a inside look and you could see that it was working before other people could see that it was working. And so I think the perspective on the part of that investor was like, okay, cool. Like, let's lock this in. Like, and our perspective was, okay, give us credit for the growth that we're very clearly going to do. We were anticipating raising a Series A in the following year, but like, if you'll basically give us credit for the progress that we're going to make in that time, sure, like, let's get it done.
Yeah, and then you showed up for the partner meeting, I think, for that very first firm. What happened?
Yeah, here's the twist, which is it seemed like it was going super smoothly. And the partner was like, listen, I'm definitely going to make this investment. And it was a partner at the firm. They were like, look, I'm definitely going to make this investment. You need to come to the partner meeting on Monday. It's like kind of a formality. Like, we'll just give you the term sheet right afterwards. You'll sign it. We'll have done your Series A. Like, we'll have the bottle of champagne or whatever, and we'll like go on our way. And so we present in the partner meeting, and then we like get tucked into a conference room, and the partner's like, cool, I'll be back like in 15 minutes with a term sheet. 15 minutes goes by, nothing happens. Another 15 minutes goes by, nothing happens. Another 15 minutes goes by, nothing happens. And then like the person shows up and he's like, actually, I'm still trying to work on this. The partnership is not as into it as I thought it was going to be. Like, it doesn't seem like I'm going to be able to get this done. And I was like, my jaw dropped. I was like really surprised, because I was just so sure that this was a done deal. And I think the lesson for that for me is like, look, we were 3-time founders. We'd raised a ton of money before. Like, it's like we had a real track record. I thought for sure at this point we'd like had this game figured out and this all dialed in. But consistently in every round we've raised, there's always been a moment where like it doesn't feel like it's going to happen. Or there's like something can like crop up and just like derail the thing. And so I think my advice there is just it's never done until it's actually done.
I've heard that a lot in this context before. And that was, I think you did finally end up doing one. It was like 2019-ish. Is that the right time?
Crunchbase thinks it was March 2018 that we announced the Series A.
That's always the funny thing when you look at some of these data sources, they'll be like, oh, X amount was raised in whatever time period, but that's just when it's announced, right? Like I remember seeing all these things being announced in 2022, and I was like, that happened in November of 2021.
Right. It's totally a marketing thing. No, in this case, I think, I remember we were having conversations in like December 2017, and then probably it took about a month to close. So like, it was definitely early 2018 that the cash hit the bank account.
You did a Series B, $40 million from Index. You had an offer for about twice as big of a round that you didn't take. Why did you take half the money that you could have taken?
This goes back to the temptation of having money is that you spend the money, and that in general, burn basically only ratchets upwards. And so you have to figure out how to strike the balance in a really thoughtful way, which is you of course want to capitalize the business well. And in general, it is better to overcapitalize than undercapitalize. If you've raised too much money, the risk, I don't know, I guess is you've deluded yourself too much. But if you don't raise enough, the risk is your company stops existing. Obviously, that's much worse. But at the same time, I think you need to not get too ahead of your own metrics. There is the check people will write you. And then there's well, what is your company actually, and no one knows, what is it actually worth? Or what is the right, true stage appropriate, amount of money for you to have raised, valuation for you to have, et cetera, et cetera. And I think you just don't want to get too far ahead of that because it's debt you're going to have to pay down later. And I think we're seeing that a lot now where there are folks that raise these astronomical, eye-popping rounds in 2021 or whatever in amazing economic times. And now definitely have a bunch of work needed to grow into that. And our feeling on the Series B was let's not make that mistake.
Yeah. And I guess a way to sort of square into that is you just look at a company that's publicly traded every single day. The market says, what's this company worth? Whether it's based on the number of users they have, customers, revenue, the margin profile, how much cash flow it actually generates. That's typically what a company's valued on. And then you say, okay, this publicly traded company, that they're growing this fast with these kind of numbers. This is what they're worth. And you just kind of say, people are paying 10 times the revenue or the cash flow for this one. Maybe we're comparable, or maybe we're growing a little bit faster. So we're worth 12 times or 15 times. I don't know. There's always a little bit of art to it, but you need to be grounded in some kind of reality, which can be, sometimes things get disconnected.
Totally. And I think it's dangerous when they do because you also start believing it, you have to remember that your valuation or whatever is not, fundraising is not success. It doesn't matter what the terms were. That doesn't mean you've made it or not. The only thing that governs whether you've made it is do you have customers? Do they love what they do? Do you love what, do they love what you're doing for them? They give you money for it. And is the business growing?
And then I think you raised a Series C from Sequoia and Whale Rock. It was $100 million based on what it seemed. Again, the public statement was, you just try to be pretty reasonable about how much you're raising. This is in 2021. Were you able to be pretty disciplined in 2021, you feel or?
I do. I mean, I think the market has obviously shifted a lot in 2021. Just with the Series B, there were more egregious and tempting offers that kind of crossed our desks.
Yeah.
And our perspective was we don't think this is the right thing for the business. My favorite thing about the Series C, obviously great investors, Sequoia, Whale Rock, others. Jeff Bezos' family office joined as well. Bezos Expeditions is the fund. And so I was pretty pumped about that. A long time ago, I was an intern at Amazon. I was a software engineering intern. So that was a cool moment for me. It's we got Jeff on the cap table.
That's really cool. So I'm trying to think of, maybe we could kind of transition into almost rapid fire. Do you have a favorite CEO or founder or business that you really look up to? And this can be current or historical, any specific one or two that really stand out?
I mean, this is a little bit of a controversial statement these days, but I have a lot of respect for what Jeff Bezos did at Amazon. It's amazing how much that business has grown, and it hasn't been an accident, and it has been the result of a series of really disciplined kind of operating principles for how they run the business. And I think there's a lot, again, I think we could have a robust discussion about Amazon's effect on American society. But I think, as a CEO, I think there's a lot to be admired in what Jeff Bezos has built.
And it was really interesting building it during the 90s. I remember seeing interviews with reporters where they're you're an internet business. Why are you building warehouses? Why are you building real estate? That doesn't make any sense. You should just be internet only. And It was a contrarian thing to do at the time, but that's actually what you had to do to make a real company. Just kind of keeping it moving on the quick questions. Favorite interview question when hiring at Pilot?
It's a good question. I'm not a huge fan of kind of like cute gotcha questions. I think the best interviews ideally like mirror the actual role as much as possible. The best way to find out can you do job X is to like try to simulate the experience of doing job X. And so in some ways, I think like the highest signal interviews for me, and I've done a lot of like, most of my interviewing these days is like in sales and marketing, is like if we're interviewing a sales rep, it's like the mock call. Like I'm a big fan of the mock call because it's just like this is what the job is going to be. Like, let's just see how you do with it.
So is it like the sell me this pen, but sell me Pilot?
Yeah. I mean, and the reason I don't like sell me this pen is it feels like gotcha. It's like, look at the website before our call. I'm a tech CEO. I'm calling in. I want to buy Pilot. Like, what do you tell me?
Do you have a favorite new startup or tool that you've discovered recently that you really like using?
This is like not a contrarian opinion at all, but I'm like blown away by all the ChatGPT stuff. ChatGPT's ability to like, in a way that our engineers hate, like I still sometimes write code, like not in our actual production systems, like I don't have commit access there, but I like write a bunch of like little helper Python scripts, like help me do some data analysis or whatever. And it's like, that stuff just goes so much faster with Copilot or with just asking ChatGPT to do the thing. And again, not a hot take. I think I'm not unique in discovering this, but that has been really amazing for me personally.
My friend Shrav, founder of Secure Frame, friend of the show, he said that the show Silicon Valley was based on your two startups and you actually helped write the show. What was that like?
Sure. So my co-founder, Jessica, was a senior technical consultant on, I think, several seasons of Silicon Valley. And I chatted with them for a couple episodes. And there are definitely some anecdotes from HSpice that are very present in the story. I was very impressed at how well researched the show was. Like the team went to great efforts to really, really kind of nail the details. And I think you can see that when you watch it. Like it feels authentic because it is.
I kind of wish it was still going. The crypto and the 2021 and I mean even the AI stuff probably just would have been so fun. Such
Totally.
Good content. Anyways, this has been awesome. Thanks for taking the time. And thank you for taking the time. If you want to support the show, share this with a founder who hates doing their own accounting. You can also like, subscribe, comment, retweet, leave a review, or name your firstborn after me. Thanks again to Waseem for coming on, Secure Frame for supporting the show, and for you again for tuning in. See you next time.